Over the past few years, my portfolio has delivered a steady growth, and I didn't spend hours every day tracking stocks. In this video, I will show you my performances and my approach to detect companies worth investing in for the long run. Like most investors, I don't have endless time to analyze every single stock out there. It's the reason why I use a stock screener to narrow down companies worth a deeper look. I am a long-term value-driven investor. I use data, not hype, to make decisions. So if I cannot justify a company's price, even if it's trending, I simply don't buy. Amazon, Palantir, great businesses, but not always at great prices. As you know, time is money. So let's not waste it and let's dive in. I have two different accounts. The smaller one where I have invested in Alphabet, New Holdings and Pandora. A bigger wallet with Booking, American Express, Betsson and some other companies. Of course, all my positions are not in green. I do have some losses, but I am still confident in the quality of those investments. Overall, you can see that I achieved a good performance, with 62% on my smaller account and 31,000 euros in benefits in my bigger wallet. It represents around 39% in plus value. Now, let's discuss my method to detect interesting companies. As I said earlier, I use a stock screener with the following filter parameters: a market cap bigger than $2 billion, a gross margin bigger than 30%, a ROE, ROIC, and operating cash flow margin bigger than 10%, and finally, a DCF factor bigger than 1. But what is the DCF factor? The DCF factor is simply the intrinsic value computed from a DCF model divided by the current stock price. If the factor is bigger than 1, it means that the stock is undervalued. For my DCF model, I use a discount rate of 8% and the gross, operating cash flow and capex margins on the company's performance over the past 5 years. You might wonder why I choose a discount rate of 8%. It's simply because it's close to the average expected return of the market. Moreover, you should understand that the intrinsic value, computed from a DCF model, is really sensitive to the discount rate. Here is an example with Google for the year 2024. We have our DCF model with a WACC, or expected return or discount rate, of 8%. And we compute an intrinsic value of 162. Now it's a result with a WACC of 10%. And we can see that the intrinsic value that we computed is 121, a loss of 25% in intrinsic value. That's why you can choose a discount rate which is too aggressive, like 15%. Imagine missing the chance to invest in Google at a fair price with an expected return of 8% just because your expected return was too high. Now, let's illustrate what we have discussed so far with the help of my app StockQuest AI. From the menu, you can access to the market screener, where you can filter stocks based on your own parameters. I added a button to directly set up the same filter that I personally use. From there, you can sort companies by ROIC, DCF, and DCF&G. ROIC is a return on invested capital. It's a net operating profit after tax divided by the invested capital. The invested capital is basically what we have put in the business to be able to operate. Capital and financial debt. The DCF factor is what we have just discussed earlier. DCF&G is the same than DCF, and it's without considering the growth. Now, let's see what interesting stocks we can find. We have plus 500, a stock that I personally own, because the ROIC is really great, and both DCF and DCF&G values are bigger than 1. I made also a video about that stock to highlight how important shareholder return is to the management team of this company. We have ASML, and with these numbers, you can see how important it is to maintain their growth and margins for this company too, given the fact that DCF is above 1 and DCF&G is under 1. We have Adobe, and we can see that the ROIC is really solid and DCF is above 1, meaning that with growth, it seems that the stock is undervalued. Let's take Adobe as an example. We can see that the quality of this company is really great with a 10 out of 10. Moreover, the valuation, it seems that the stock is fairly valued. Indeed, if we look at the graph of DCF, we can see in purple the DCF taking into account the growth and the DCF without growth in white. And we can see that the price of the stock is currently right in the middle, meaning that the stock is fairly valued. Moreover, the pair euro-dollar is 1.17, meaning that for European investors it might be a good idea to invest in dollars since we can expect the euro-dollar pair to be equal to 1 in the future. Moreover, looking at the latest report, we can see that the management team is quite confident about the growth and margins of this company. Then, with a quality score of 10 out of 10, what can happen to Adobe? Competition with Figma or Canva? I don't think so, because Adobe is still considered as a standard in the creative industry. In my opinion, it's like Microsoft with Office with Google products. Microsoft with Office is still considered as standards in the industry. What else do we have? We have Betsson, a company that I own too because we have a high ROIC and both DCF and DCF and G values are above 1. Imperial brands, it's the same. High ROIC, DCF and DCF and G values above 1. Moreover, we can see that it's the same value between DCF and DCF and G, meaning that this company is probably a mature company and don't have any growth. We have American Express with a high ROIC and both DCF and DCF and G values above 1, which is also a company that I own. Moreover, even Warren Buffett owns this company in its portfolio. But you will tell me, with such criteria, you will never invest in Google or Meta or Booking. But let's look at Google, for example. If you look at the DCF graph, you can see that it was interesting to buy Google in 2022. Moreover, earlier this year, the company's price was around 150, which was also a good entry point. Looking at Meta, you can see that it was interesting to buy Meta or Facebook between 2016 up to 2022. Finally, looking at Booking, you can see from the DCF graph that it was interesting to buy Booking since 2022, and it's only recently that the stock seems to be a bit overvalued. In conclusion, as a French father says, you should never be in a hurry to make a bad deal. From time to time, great companies will pass through your filter and you should be ready when it happens.